John F. Ehlers is a name every serious trader should know. He's not your typical analyst. He's an engineer who brought scientific rigor to trading. Instead of just spotting chart patterns, Ehlers looks for the hidden cycles that drive prices. His book, Cycle Analytics for Traders, is a guide to understanding the mechanics behind market movement. Why care about cycle analytics? Because most indicators lag, they react too late. Ehlers used engineering to create tools that adapt in real time, aiming to anticipate price moves by uncovering market cycles. This proactive approach can help you catch trends earlier and exit before reversals. The core idea: markets move in cycles, like waves, sometimes big, sometimes small, but always present. Learning to measure these waves is the key to cycle analytics. It's a step up from guessing or relying on lagging indicators that often fail in choppy markets. Ehlers' book is about applying signal processing principles to market data, not memorizing patterns. He shows how to build smart indicators that adjust to changing conditions. In this summary, we'll explore what cycles are, how to find them, and how to use adaptive indicators to trade them. The logic is simple: find the market's rhythm and trade with it. This approach offers a scientific edge over traditional methods. If you want to move beyond guesswork, Ehlers' Cycle Analytics is your next step. Let's dive in. Cycle analytics starts with a simple truth: markets move in cycles. A cycle is a repeating pattern like seasons, but in price. Prices rise, peak, fall, and bottom, then repeat. These cycles exist on all time frames, but they are often hidden by market noise. Ehlers' work is about filtering out that noise to reveal the true cycle. Market prices have two parts: trend and cycle. Separating them is the first step to successful cycle trading. Key cycle trades: period, how long a cycle lasts, and amplitude, how strong the move is. Cycles aren't constant. A 20-day cycle can become 15 or 25 days. Traditional indicators with fixed settings fail when cycles shift. Ehlers realized you need tools that measure the current cycle in real time and adapt. This adaptability is the foundation of his approach. By measuring and following the dominant cycle, you can stay in sync with the market. It's a flexible, scientific way to trade. That's what sets Ehlers' methods apart. To uncover hidden market cycles, Ehlers turned to digital signal processing, DSP. DSP is used in engineering to analyze signals, like sound waves. Ehlers saw market prices as a signal too. By applying DSP, you can break down price action into its core cycles. Tools like the Fourier transform reveal which cycles are present and which are strongest. This approach is mathematical, not subjective, giving precise, objective measurements. Ehlers translated these engineering concepts into practical trading indicators. Now, traders can see the market's true rhythm, no engineering degree required. Ehlers' biggest contribution is adaptive indicators. Traditional indicators use fixed settings, but markets are always changing. Ehlers indicators measure the current cycle and adjust automatically. For example, his adaptive moving average changes its period to match the market's rhythm. When cycles are short, it's more responsive. When cycles are long, it smooths out noise. This reduces false signals and whipsaws. Adaptive indicators work in all market conditions, trending or sideways. They are smart tools that interact with market data, not just static calculations. This adaptability gives traders a real edge. Cycle analytics is about trading with the market, not against it. Compare Ehlers' approach to traditional technical analysis. Standard tools like MACD and stochastic use. Fixed period zone, size fits all. Cycle analytics customizes itself to each market's unique rhythm. Instead of imposing a structure, Ehlers indicators listen and adapt. In choppy markets, traditional indicators give false signals. Ehlers tools recognize uncertainty and adapt or stay flat. Lag is another issue. Traditional averages react slowly. Ehlers zero-lag indicators follow price closely without excess noise. This means earlier trend detection and better timing. The result? More precise entries and exits. That's the power of adaptive, cycle-based analysis. Two key Ehlers tools, MESA, Maximum Entropy Spectral Analysis, and the Sine Wave Indicator. MESA analyzes recent price data to find the dominant cycle period. The Sine Wave Indicator then visualizes this cycle, plotting two lines, sine and lead sign. When the sine line crosses above the lead sign, it signals a cycle bottom-up buy. The lead sign turns first, giving early warnings of reversals. In strong trends, both lines move together. As momentum fades, the lead sign crosses, signaling exits. This system provides clear, objective entry and exit points. MESA finds the cycle. The sine wave times your trades. It's a systematic, emotion-free approach. You're trading the market's heartbeat, not guessing. For deeper analysis, Ehlers uses the Hilbert transform. It measures the dominant cycle period in real time, bar by bar. Think of it as a tool that instantly detects the market's rhythm. The output dominant cycle period shows how long the current cycle is. This real-time data powers adaptive indicators like a stochastic or RSI that changes its look-back period automatically. If the cycle is 30 bars, the indicator uses 30 bars. The math is complex, but trading platforms handle it for you. Your job? Interpret what the indicator tells you. By measuring and adapting, you create a highly responsive trading system. That's the essence of Ehlers' philosophy: measure, adapt, and trade with precision. Theory is great, but making money is the goal. Start by using cycle indicators to confirm trades, combine them with support and resistance for stronger signals. In trend trading, adaptive moving averages filter out noise, while the sine wave indicator times your entries. Buy the dips in an uptrend when the sine wave gives a buy signal. Ehlers tools help you identify if the market is trending or cycling. Use trend-following strategies in trends, oscillator strategies in cycles. The indicators themselves tell you which mode the market is in. Example, on EUR, USD, if the dominant cycle period is steady at 25 bars, tune the sine wave to 25. Wait for a buy signal, enter with a stop below the low, and exit on a sell signal. This is a clear, rules-based approach. Cycle analytics adds confidence and precision to your trading. It's about adapting your strategy to the market's current state. The result: more consistent, objective trades. That's how you put Ehlers' ideas to work. Ehlers Cycle Analytics offers a scientific, adaptive alternative to traditional analysis. These tools measure the market's dominant cycle and adjust in real time, reducing lag and subjectivity. The result? More precise entries, earlier exits, and better performance, especially in tough markets. The main benefit is objectivity. Signals are based on math, not guesswork. Zero lag indicators let you react quickly to market changes. But no system is perfect. Cycle analytics works best when a clear cycle is present. In low volatility or news-driven markets, signals may be less reliable. Always use proper risk management. Ehlers' work encourages traders to think deeper and adapt. Psychoanalytics empowers you to trade with the precision of an engineer.